All right, happy Thursday afternoon. We are here live on YouTube, and whoever is watching, thank you for watching. My hope was to talk today about the latest and freshest tax updates, but so far we don't have anything solid yet. We have only conversations and talks and rumors, so we'll delay taxes. And today we'll talk about another important subject, which is hedge funds, and why hedge funds are coming up more and more often lately. Well, it's because usually to balance out risk in your portfolio, what do you have? You have stocks and you would have bonds. Then you would diversify stocks amongst different sectors and you diversify your bonds based on return and duration. And you should be okay, kind of protected from the stock market volatility, unless all the sectors and the stock side of your investment go down together because the whole system goes down, and or bonds become volatile, like what happened in 2022. Bonds went down, they were more volatile than stocks. So, and we anticipate this happening over and over again just because the interest rate environment is not very stable right now. It will be changing all the time, we think. So, hedge fund conversations come up more and more often. What is a hedge fund? Well, traditional classic definition of a classic hedge fund is an alternative investment which is designed with the purpose to maximize return while minimizing risk and not to be correlated with your other investments. In other words, whatever your other investments are doing, they might be dependent on your S&P 500 or your index or stock market, and your hedge fund investment is not correlated with it. It can have the whole their own rhythm and pattern. And this way, because you are reducing the correlation to the stock market, you diversify and therefore minimize your risk, your exposure to the stock market, to the risk that the entire system, the systematic risk, the entire system will go down, right? So that would makes hedge funds compelling. Additional thing that's a big, huge benefit of investing in a hedge fund is that hedge funds are designed in a way that they can invest in both long positions and short positions. In other words, they can bet on the index of funds to go up in value and to go down in value, and they can profit in both directions when the stock market or funds index goes up and when they go down. So that's the main attraction of the hedge fund, right? You don't care what the stock market is doing. All you care about is what your hedge fund is doing. All right, so hedge funds have different structures and they're designed in different manners. They have their own rules, regulations, they have their own goals and sectors they monitor, and their styles of investment. The most popular structure right now at this time is multi portfolio management, like multi-management hedge funds, where you have multiple portfolio managers operating under one risk management structure. So basically, they all have their own goals, they all have their own frameworks, but one common management, one entity is managing the risk. This way, all these managers, various managers, they are not correlated with each other. They move independently of each other, and this way your risk could be dramatically minimized while still you can reap great returns. While with these complicated structures, right, and big research about technology and brain power which needs to be invested in these hedge funds comes fees, right? How much does it cost to have your money in a hedge fund? All right, fees vary. It could be less, it could be more, but traditional template for the fees, traditional structure is 2% fee charged on net asset value plus 20% of the profits which the hedge fund generates. So 220 pattern. It could be different. Some hedge funds may offer 1.5% fee or 1% fee and higher portion of the profits. Some hedge funds might focus on the profits, focus on the fees and charge you less on the profits. It could be all different. It all depends on the fund and on their target. Now, minimum. You probably hear that many investment advisors and many money managers, including hedge funds, they have certain minimal investments. They don't want to deal with small potatoes, right? And ordinarily, the minimum amount which is required to be in a hedge fund is somewhere between 500,000 to $5 million. Yeah, it can get really high, and normally the better established the fund is and the better known the fund is, the more like the brand name, the higher the minimum, especially if this hedge fund is affiliated with big banks like Morgan Stanley, Merrill Lynch, or you name it. So these guys, their minimums are much higher than other hedge funds available out there. So what, $500,000 or 5 million is a lot of money. What if you don't have such money to invest in a hedge fund? Well, can you do anything about it? Well, with the growing popularity of the hedge funds, by the way, in 2024, the total investments of the money managers, assets under management, managed by the hedge funds, was over $5.5 trillion. So they are growing in popularity. With growing popularity and demand for alternative risk management, some independent investment firms started offering hedge fund-like style of investment, or smaller. There are also, you can find smaller hedge funds. Smaller, newer hedge funds will have lower minimums and probably lower fees. Also, some registered investment advisors offer this style of management as well. You just have to do your research and check them out. So if you have hedge funds in your head and you are curious about it and you just don't know where to go and how to start, come to us, to Serenity Wealth Management, and we can look at various options and evaluate what could be possible for you. Now, standard disclosures. We have to say all these things. This video is not intended as a financial, legal, or tax advice. This is not an advice. This is just piece of information. This should not be considered as a research. None research has been done. This information was not endorsed, approved, or sponsored by any of the hedge funds, any of the investment advisors, any of the brokerage houses, or any banks. This is our opinion only, and again, it should not be considered as an investment advice. Sorry, have to say it as a small fund. What are we going to do next week? So we covered our hedge funds here today, and I will send an email. You will get an email. If you want to get emails with a detailed description of what I'm here talking about, you can give me your email and I'll put you on the list and you'll start getting the emails. All right. Next time, we'll be talking about probably latest tax updates if we get any solid confirmation or proposal, and or we'll talk more about real estate, because many of our clients have money invested in real estate or just real estate sitting there as an alternative investment. So we'll talk about that portion of the assets. All right, on this note, thank you for watching. I hope you liked this information that gave you some ideas. Please leave a comment. If you subscribe to this channel, you will be notified when we schedule the next video, and you will be notified what it is going to be about. In the meantime, have a wonderful week. Reach out with the questions about hedge funds, and let's make it a really, really good week. Ciao.